If you want to master SMC, this is where everything starts. No shortcuts, no skipping. So guys, let's get into it. Now, first of all is what is Forex? To explain everything in a very simpler way, Forex means changing one currency for another. That is Forex what? That is Forex trading. If you are changing one currency to another, for example, the EURUSD. If you are trading EURUSD, it means that you are buying the euro and you are selling USD. That is what it means. You are buying euro and you are selling what? USD. Now, don't let other people deceive you in this particular market. The market only move in two ways. It's either we are going up or we are going down. Why? It is because of the buyers and the sellers. If you check your MT5, your MetaTrader 5, you will see that you have only column for buy and column for sell. It's either you're a buyer or you are a seller. Now, if the buyer are so strong, price is going to push up and keep on pushing up to the upside. But if the seller are stronger, then price will do what? Start pushing to the what? To the downside. I hope you understand. So now let's talk about candlestick and everything you need to know about what candlestick. Now listen, every movement you see on your chart is made up of candlesticks. All these movements, all these things now, this blue thing is a candlestick, black is a candlestick. All these movements, they are made up of what? Candlestick. And again, each candlestick has these four things that I listed out here in common. First of all is the open, the close, the high, and the low. Open is where the price started. The close is where the price ended. The high is the highest point, and the low is the lowest point. For example, this bullish candlestick you can see over here. This is the open here. It opens below and it closes above. This is the highest high it can get to, and it has already get to. And this is the lowest low it did, showing that this is a bullish candlestick. This on the other side is a bearish candlestick. It opens above. Now you can see the difference. The bullish candlestick opened below, but a bearish candlestick opened what? Above, and closes what? Below. This is the high it can get to, and this is the low it can also get to. Do you understand? This is everything about candlestick. You can see it over here in EURUSD. This is where this particular candlestick opened, and this is where it closes, showing that this is what? A bullish candlestick, which means if price opens below and closes above, that is what? A bullish candlestick. But if price open above and closes below, that is what? A bearish candlestick. I hope you guys understand. So next we'll be talking about time frames. We have so many time frames in the market. So many time frames. You can see my list here. You can see list of time frames that we have. But the most important one is our monthly time frame, weekly time frame, daily time frame, 4-hour, 3-hour down. But if you want to trade, you can start with the weekly time frame, daily time frame, 4-hour time frame, 1-hour time frame, the 15 minutes time frame, and also what? The 5 minutes time frame. I hope you understand. So now, in the weekly time frame represents only one candlestick, which means one candlestick represents the weekly time frame, showing that everything that happened in a week, a particular candlestick represents it. Daily time frame is everything that happened under 24 hours. One candlestick will represent it. 4-hour time frame means after everything that happened in 4 hours, one candlestick represents it, and so on and so forth. This is we are in the 1-hour time frame. This is the 1 hour time frame. We are in the 1 hour time frame, which means this particular candlestick represents for each hour. You can see it. This is 6 p.m., 7 p.m., 8 p.m., 9 p.m., 10 p.m., and 11 p.m. Each candlestick stands for each hour. Monthly, each candlestick stands for each month. 15-minute time frame, each candlestick stands for 15 minutes. 4 hour time frame, each candlestick stands for 4 hour each candlestick stands for 4 hour time frame. So now time frames are just different views of what, of the same particular market, and I have break down everything into smaller pieces for you to understand. Now the higher time frame equals to the 4 hour time frame, the daily time frame, and the weekly time frame. Which, what is the work of it? This shows you the directional bias of the market, the direction of the market, if we are going up or if we are going down. This is the time frame in which you are going to be looking at the market with the 4 hour, the daily, and the weekly. Now in the lower time frame, we have the 15 minutes, 5 minutes, and our 1 minute. This is for entries only. You cannot use the 15-minute time frame to predict your daily bias. It's not possible. You will lose tire. You will lose. You understand? So, but I'm going to use it for only what? For sniper entries. Okay? So always remember this. The higher time frame will tell you where price is going, while the lower time frame is gonna tell you when to enter. If you ignore this, you will keep losing money in this forex space. Now let's talk about trading section. Under trading section, you can see I listed 5 trading sections, but don't be surprised that inside these 5 trading sections, only 3 are important. And I'm going to tell you that right now. First of all, we have the Asia section, London section, New York section, Tokyo section, and Sydney section. With the settings, you can already see the 3 that are important already, which is our Asian, London, and New York. These 3 are the ones that are what? Important. These 2 are not important. They are just a correlation. Now, Eastern section, this Eastern section, everything that happens in the Eastern section is always slow and is mostly what? Ranging. It starts from 1 a.m. Nigeria time, 1 a.m. to 5 a.m. That is when we are already in encounter with the Eastern section from 1 a.m. to 5 a.m. Nigeria time. And what I said earlier, it's always slow and ranging. That is why we are using it for our CRT ranging candlestick or London key zone strategy. We are using it for that. So the London section, this is where the real move happens. Liquidity gets taken where? During the London section. How does that happen? The Eastern will form a range and London section will now open to sweep, neither it being the high or the low of Asian, forming what? Our liquidity sweep. The London section starts from 6 a.m. to 10 a.m. That is when the London section starts. You can see it here, 6 a.m. to 10 a.m. After that, from 11 a.m., the New York starts. This is just a continuation of the move. It's either it continues the move or it reverses. This starts from the 11 a.m. to 2 p.m. You understand? So if you want a better and better good result, you focus on the London section and the New York section. Let me show you guys how you can be able to understand and apply this particular section on your charts. Now on your chart, this is the indicator. You can see it here, the ICTKZS. This is the particular indicator that shows you your London section, your New York section, and your what? Your Asian section. So now follow the settings. You can follow my settings to set this up. You can see this is my settings. This is everything that I set. Then you can use it to set your own up. Now this is the Asian range. This is our London section and this is our New York section. this particular indicator is going to be keep on showing you guys everything about it, everything about this Asian Open, New York close. Okay, once you have the indicator set already, you'll be seeing everything about it. Asian London, New York, Asian London sweep, New York expansion, Asian London sweep, New York expansion, Asian London sweep, New York what expansion, and so on and so forth. Okay, let's continue. Now let's talk about pips. Let's talk about money terms. Now, what is pips? This is how we measure the movement. Finish. The movement from one particular price to another price is being measured in pips in forex trading. Now, if price move from 1.1100 to 1.1200, that is what? That is 10 pips. How many numbers were being added? Only 100. Instead of 100, minus 1, minus 10, the last zero, then that you're going to get your what? Your 10 pips. If 300 is being added minus the last zero, that is going to make it what? 30 pips. Example, if price is in this particular place, let's say price is at 1.15600 and another price is at 1.15700. Now, from here to this particular place is only 10 pips because we added 100 figures, and that 100, if you minus 10 from it, is going to remain what? 10, which is making it 10 pips. Let's calculate it. From here up here, you can see it what? You can see it 10 pips. So guys, let's continue. Now, after pips, we are going to have what? Spread. We are going to have spread. What is spread? I categorize it into two aspects. First of all, this is the small fee that your broker takes. And again, this is why every trade starts in what? Small loss. As a trader, you're going to notice that if you want to place trade, the moment you click on buy and sell or sell, automatically you're already in the red. You may be in a red of minus 14 cents, minus 15 cents. That particular cent is the fee. The broker already minus their fee, their broker fee from the trade automatically. So you're already in a drawdown. So the higher the loss size, the higher the fee. Do you understand? That's just it. So next time, if you place any sell or buy and you see automatically minus 0.5 US dollar, don't be afraid, don't be scared. That 0.5 US dollar is the fee that your broker have already minus. You're only going to make it back if you make profit in the market. You make your money back. But if you make loss in the market, you have lose your money. But your broker is still what? Profitable. Now let's talk about lot size. Under lot size, this is what controls your profit and your loss. If you're trading 0.01 lot size, which means you'll be making small money and you'll be losing small. But if you're trading 0.10 or 1 lot size or 2 or 100 lot size like some forex trader, you'll be making bigger money. And you also be setting your account up for what? Bigger losses. Do you understand? Okay, let's continue. Now, as I said here, the higher your lot size, the faster you gain, or the faster you are going to what? You are going to lose. Your lot size will go to determine if you buy your latest Lamborghini, Ferrari, or any car you want to buy. Your lot size matters a lot. But if your account is at $100, I will advise you to use 0.01. If your account is at $1,000, I will advise you to use 0.10. But if your account is from $10,000 20k dollars, 50k dollars, you can use one standard lot size. You understand? Any lot size that starts from 1 is a standard lot size, and any lot size that starts from 0 point is a micro what? Lot size. Let's continue. So to bring everything you just learned in this particular episode together, first of all, I said candles showed you what happened in the market. Everything that happened in the market is being translated to you in candlesticks. That's why you need to learn and understand the formation of those candlesticks. Okay, time frames will show you again where market is going to, when and where it's coming from. Time frame is going to show you all that. Okay, now sections is going to show you the best time for you to trade, which I said that the best time for you to trade is the London section and the New York section. Why? Pips and lot size is for you to be able to control your money. Okay, so if you understand this, and you have just built your foundation in trading. And I'm going to be glad if I can be able to see you in the next episode, where we'll be talking and diving deeper into the market. Now, go back to our previous video where I scheduled out and I gave you guys the scheme of work that we are going to be following, scheme by scheme, to reach the end of this particular episode. Okay, see you guys in episode 2.